Welcome everybody to this version of Friday Market Insights. Today, it is myself, Grant Conroy, Portfolio Manager and Partner at Janus, and Justin Hahn, who is our macro guru at Janus. And jumping right in, Justin, the traditional question, what happened in the markets this week?
Yeah, so this week we saw the S&P 500 continue its momentum from last week, up about 2% for this week. The week started off in the macro data wise with the IMF increasing global GDP estimates up to about 6% from 5.5% that they estimated in January. During the middle of the week, a lot of the focus was on the US Federal Reserve's minutes, but that became more of a non-event because it just reiterated the same things that they were saying during the press conference, such as they're going to be patient during the next first rate hike, as well as more patience in terms of tapering their balance sheet. The biggest thing on the investors' mind for this week was also the infrastructure plan and more about what's going to be in the bill and more details about it, but there's still a lot of uncertainty around that.
Great, yeah, and it seems every week there's something out there to focus on or something new. And every time I do this video, it seems that the markets are at all-time highs. So either I'm a lucky charm or the markets just continue to get new highs every week. But having said that, with them hitting all-time highs today again, I think, what are the tailwinds and what are the headwinds that are out there that we should focus on?
So the biggest tailwinds we see for the market is the upcoming stimulus bill for infrastructure spending, which is going to help continue to stimulate the economy, as well as the global vaccinations that's going to happen throughout the year. Some of the headwinds, though, are more of the inflation numbers as well as market valuations. Last night, we saw China's inflation numbers a bit ahead of the estimates, and overnight, we saw futures fall on that news. Chinese inflation does have an impact on US inflation as well because a lot of the parts are still made in China. In addition to this, we also expect some of the corporate tax rates to increase with the upcoming infrastructure plan. The proposed tax increase is from 21% to 28%, but we believe there's going to be some kind of compromise around the 25% mark.
Right, and I guess that probably takes a while to kick in, but the market looks forwards, I presume. So how do we view the outlook given all of those bits you just mentioned, and have we changed and have we made any changes in the portfolios as a result?
In terms of our portfolio, we recently actually moved our equity weightings down in order to favor cash. This was a move due to our signal, the world equities versus cash signal turning negative due to some of the things I mentioned, such as the higher valuation measures in the equity markets, as well as different inflation indicators ticking up. We saw the Canadian CPI signal increase, as well as the German PPI signal also increase there.
Right. And as we've made those changes and seeing through the week some of the changes we've made, and we move into a bit more cash, is cash an asset class? Can we consider it an asset class, do you think?
Yeah, we believe that cash is an asset class, and is very important during the times when bonds and equities are looking very toppy as they are now. It also gives us the ability to hold something in order to use it going forward. If there is a big market pullback, we'll have some cash that we're able to spend and put it into either bonds or equities. We have also been overweight on equities quite a bit throughout last year and this year during the recovery and the bounce back of the markets. So this is some of the profit taking, and we're just taking a little bit of a less aggressive stance.
Right, that's great, thank you. And hopefully for many of the clients that are watching, they've noticed the overweight equity in terms of the performance figures as well through the last 12 months or so. There seems to be still, though, a lot of crowding in those large stocks in the market, the sort of big cap tech names that led the way last year. And is that a risk overall as well?
Stock crowding still remains a big risk. Indeed, as we saw during last month, we saw the technology sector crash almost 10% and correct, but it did come back quite a bit, but it's still behind the broad market. A lot of the other sectors in the market have gone to new highs, while the technology stocks still remain a bit lower. A lot of these companies have also done really well during the pandemic and have been actually increasing labor force and increasing profits during these more digital times, as well as people working from home and people schooling from home as well. As the economy opens up, we expect a lot of these companies to miss some of their projections due to an overestimation and those estimates to come down. So there's a big risk there still in the technology side.
Right. And I guess it's a little bit of a prisoner's dilemma. If nobody sells, they all carry on moving higher and it's all good. But as soon as somebody sells and everybody runs for the exit, I guess you could see some abrupt moves in some of those larger names at some point. And then finally, I noticed the AAII investor sentiment was released this week, and the bullishness level was the highest since 2018. So just to put some context there, I guess it's a survey where they ask people, do you think the market's going up? Are you bullish? Do you think it's going down? Are you bearish? Or is it neutral? And the amount of bullish responses was a very high level. Is that a good sign?
High investor confidence is always good for the market as people continue to buy, but we've seen that these sentiment indicators can drop quite quickly and sharply. In addition to this, however, we've also seen consumer confidence at all-time highs as well as PMIs at all-time highs. So all three kind of reinforce the story of more confidence in the economy and in the markets for investors.
Great. I do know sometimes people are more bullish once they've bought. So sometimes the argument is when it gets too high, that means that everybody's finished buying and then they're bullish, and who's left to buy from here. But anyway, well, thank you for that, Justin. That's great. And for those who are watching, I hope you took something from this. And as ever, if you have any questions or suggestions, please feel free to contact your PM. And with that, have a great weekend. Thank you.
Thanks, everyone.